Hey, I'm Jonathan Wild, and we are going to cover how to account for the issuance and collection of notes receivable. A note is a written promise to pay a specific amount of money on demand or at a future date, and usually with interest. Let's get started right away with an example. So assume you receive an $8,000 120-day 6% note receivable in exchange for providing services to a customer. In this example, we debit notes receivable for $8,000 and credit services revenue for $8,000. We debit notes receivable to increase that asset account and credit services revenue to increase that revenue account. Another way to use notes receivable is to exchange them for overdue accounts receivable. For example, assume a customer is overdue on their $3,000 accounts receivable. The customer asks for a time extension on March 10th, and we agree to accept $1,000 in cash and a $2,000 60-day 12% note receivable. We accept this because we will now earn interest on their past due account, and we have a written promise they will pay us in 60 days. To record this entry, we debit cash for $1,000, debit notes receivable for $2,000, and credit accounts receivable for $3,000. We debit cash and notes receivable to increase those asset accounts. We credit accounts receivable because the customer no longer owes us $3,000 in the form of an accounts receivable. They now owe us in the form of a notes receivable. Now, fast forward to May 9th when the note is due. And the customer can either honor the note by paying it, or they can dishonor the note by not paying. First, let's assume they honor the note. To record this entry, we debit cash for $2,040, credit notes receivable for $2,000, and credit interest revenue for $40. The interest revenue was calculated as the $2,000 note multiplied by 12% and then multiplied by 60 over 360 days to get us $40 of interest. We use a 360-day year for this equation called the banker's rule because it makes for easier calculations. We debit cash to increase the asset account for cash received. We credit notes receivable as the customer no longer owes us money, and credit interest revenue to recognize the interest earned. Now let's say instead the customer dishonors the note by not paying. In this case, we would debit accounts receivable for $2,040, credit notes receivable for $2,000, and credit interest revenue for $40. We debit accounts receivable to recognize the customer still owes us money and now owes us the original $2,000 plus $40 of interest. If the customer tries to get credit from us again, we will see they still owe us $2,040. Now on the credit side, we credit interest revenue for $40 because we have still earned that revenue, even if the customer did not pay on the due date. Also, we credit notes receivable because the note has been dishonored and moved back to accounts receivable. To be clear, even after the note is dishonored, the amount owed is still in accounts receivable, and we will keep trying to collect from the customer.